to the GrowFL webinar series. My name is Tammy Sweet, and I'm the Director of GrowFL, and we'd like to welcome you to this webinar. This webinar will cover financing options for management, family, employee, or third-party buyouts. If you are unfamiliar with GrowFL, our mission is to provide strategies, resources, and support to second stage companies for next level growth. We focus on a specific set of businesses here in the state of Florida. These are companies, what we call second stage growth companies. They are companies between 10 and 99 employees and $1 million to $50 million in revenue. These companies are in the growth stage and have very specific needs that our programs address, including strategic research. This is a program that we've designed in order to help companies explore ways in which they can improve top-line revenue. So we work with your sales and your marketing teams in order to explore opportunities for new revenue. Our other program is peer learning programs. This includes our CEO roundtables and our CEO forums. Our CEO roundtables are programs that meet once a month around the state of Florida. They're the same 12 to 15 CEOs that meet on a monthly basis in areas such as Tampa, Orlando, South Florida is where we have our CEO roundtable programs. In addition, we have CEO forums. These are programs that occur on a quarterly basis in Tampa, Orlando, and South Florida. And this is where we bring in a seasoned entrepreneur to speak about their business and how they grew their business. It's also a great networking opportunity for our second stage CEOs. In addition, we have leadership development programs that include leadership retreats for CEOs, webinars such as this that we're presenting today, as well as our Florida Companies to Watch program, which I'll talk about in a minute. We also have a significant partnership with Florida Makes, which is the state's manufacturing program, and we are looking to put together a consortium of second stage businesses in the manufacturing industry in order to participate in a virtual roundtable. This program would occur over a 6-month period. These are 2-hour video conferencing meetings, and they follow the same format as our in-person roundtables, but will be done virtually with manufacturers from around Florida. And finally, our Florida Companies to Watch awards program. Our application period just closed for Florida Companies to Watch, so we're excited to see what happens with this period of application and to see who the honorees will be this year for Florida Companies to Watch. You can mark your calendar for February 9th of 2019 at the Strauss Center for the Performing Arts in Tampa, which we will host the Florida Companies to Watch event and celebrate this year's 50 winners of Florida Companies to Watch. You can see in this picture here is our winners from last year. It's always a great event. We're into our 8th year, so there's been 350 companies from throughout Florida that have been honored through this Florida Companies to Watch awards program. As a winner of this awards program, they do get invited to a retreat at our partner organization, Edward Lowe Foundation in Cassopolis, Michigan. So it's a really great opportunity for CEOs to not only celebrate their success with their staff, with their family, with their friends, but it's also a great leadership opportunity for the CEOs with the Edward Lowe Foundation. So we encourage you to join a GrowFL program and get involved. We have many ways that you can connect with us, connect with your peers around the state, and help to learn from each other as well as our experts. Speaking of experts, we have Chuck Austin. Chuck is here today to talk about the topic of being able to plan ahead for buyouts, whether or not it's management, family, and Chuck comes to us as a sponsor of GrowFL. He has over 37 years of commercial and corporate finance experience, and he's raised capital and developed markets for the Florida Capital Bank between 2005 and 2010, and now he's the president of Florida Capital Bank and formed Florida Capital Advisors in 2015, as you can see on the screen here. So please welcome Chuck Austin, and I will turn it over to you, Chuck. Thank you very much.
Great. Thank you, Tammy, and good morning, everybody. I appreciate you attending the webinar this morning. I hope everybody in attendance, whether you're a business owner or an advisor, finds value in the presentation today. If any of you all heard my previous presentations, I always try to weave in some slides and discussion around how to build, preserve, and grow value in privately held businesses as well. As Tammy outlined, I started Florida Capital Bank back in 2005, which turned out to be one of the worst times to start a bank in modern history, I think, as everybody knows. Had operating experience, so I know what it takes to run a privately held company from the perspective of trying to get it out of a ditch and deal with a bad economic environment and build it back to a thriving business. So I'm just not an advisor or banker. I've lived it as well. Real quick, a little bit more about Florida Capital Bank. Founded again in 2004. We have $370 million assets as of June 30 with offices, 4 offices around the state of Florida, although we do business around the state of Florida, have customers in South Florida, Southwest Florida, up and through Jacksonville, Tallahassee, and so forth. We're also a national small business administration lender, so while most of our conventional lending is confined to the state of Florida, we do transactions through the SBA lending program on a nationwide basis. We are a PLP lender, preferred lender. What that means is we do not have to go to the SBA to get our loans approved, which results in a much quicker turnaround time. And as I mentioned, we do conventional lending in the state of Florida, primarily on real estate, both owner-occupied and investment real estate. Real quick about Florida Capital Advisors. I started as a division of the bank in 2015. We were beginning to see, as we came out, had a few years of the recession behind us. A lot of our clients were business owners in their 50s and 60s, and were thinking less about adding debt and deleveraging and more about thinking about ways to transition out of the business. We do have 2 certified exit planning advisors on staff, which includes myself, and also a certified merger and acquisition advisor. Simply said, we advise on and fund change control, minority shareholder buyouts, and majority shareholder buyouts, business acquisitions, and real estate transactions. The targeted transactions, which the vast majority of them fall into these categories. There's some smaller, some larger, but we're really trying to work on the internal transfer side. Either management, family, or employees are interested in buying the company. Generally, the companies are $1 to $10 million in valuation. Again, some a little bit smaller and some significantly larger than the $10 million in enterprise value. From an adjusted earnings standpoint, EBITDA standpoint, $500,000 in EBITDA to $2 million in EBITDA, which is generally below the threshold of private equity. I'll touch a little bit on private equity. We cover about 50 different private equity groups and understand from a transaction standpoint and an investment standpoint what they're looking for. So to the extent we have a larger transaction above the $2 million in EBITDA, we can access private equity and make introductions there as well. We finance business acquisitions by corporate or individual buyers, and the typical loan sizes anywhere between $750,000 and $5 million. I always weave a demographic conversation into my presentation because it really does, like a lot of things, impact privately held businesses. So I think everybody's seen a stat like this before. Since 2011, 10,000 baby boomers turn 65 every day. I think the youngest one now is in their probably 53, 54 range, up to 71, 72 years old. As you might imagine, boomers own over 50% of the private businesses in the U.S., and a study by the Exit Planning Institute indicates that roughly 50% would like to transition over the next 5 years, which always seems to be the magic window, and only 75% in the next 10 years. Another dynamic which I think needs to be considered in the whole business transition and companies going to market are the fact that younger business owners are becoming serial entrepreneurs. That's certainly the case with millennials, and even the Gen Xers and Gen Ys are starting businesses, selling them, or transitioning out and starting other businesses. So let's talk about how demographics weave into triggering events for those that own privately held businesses. And I'm sure, and if you don't have one, you should have one if you are a multiple shareholder type of organization, is have a buy-sell agreement. And generally, buy-sell agreements address the involuntary trigger events. That would be disability or health issues, divorce, disputes, death, etc. In those particular situations, there's a very short planning horizon typically that takes place to get the company in a position to be able to finance or to take out that shareholder that triggered that buy-sell agreement. I've seen cases with companies that have multiple shareholders and don't have buy-sell agreements, or the buy-sell agreements have not been updated in years, and so they're just not very functional anymore. So what we try to engage with clients on is a voluntary type of trigger situation, which gives a much more robust planning horizon. These could include things like diversification of your net worth. Let's face it, most business owners have 70, 80%, some cases more of their net worth tied up in an illiquid single stock position. If you're in your 50s or 60s, that's a high risk position to have, whether it was publicly traded or privately held. You may have children or other family members in the business, or senior managers that have been around for a while that are looking for an ownership stake in the business. As I mentioned, I cover a number of private equity groups. They have business development people that are reaching out and soliciting opportunities directly with business owners. So you may have received an unsolicited offer for your business. With the recent tax law, estate planning issues a little less critical with the doubling of the estate tax exemption, but still relevant for some companies. So let's move on from trigger events into what are the common, and these are in no particular order, but these are kind of the biggies of what the buyout challenges are for a majority shareholder buyout. The first one there is just the interested party, whether it be a family member or key management, doesn't have the assets or liquidity in order to take out the majority shareholder. They can't even pull together the amount needed for a down payment. Even if they do, even if some of your employees do have the financial resources, they may not be the clear leader or successor. It's too late 6 months or a year before you want to transition from your business on an internal basis to identify who that leader or that successor is going to be. That's a conversation that needs to take place years in advance for a couple of reasons, least of which is that individual may not be interested in buying the business. They may be interested in being a well-paid employee, having less stress in their life, don't want to take on the risk of guaranteeing loans and the risk of owning and operating a business. So pretty important to identify who that person's going to be. Another challenge is that risk points of the business that impact value, and we'll get into this a little bit more in the next couple of slides, also impact the financing of the business. So if there are risk points there that are hurting value, those same risk points can also discourage a lender from lending into helping that company complete an acquisition. The business may not be transferable, so it's helpful to go through an exercise either internally with your management team or through the help of advisors to really understand where the risk points lie in your business. The big one is if you're highly relevant to the business, a buyer or a lender is going to give that pause. And then one that everybody should start with is understanding the value of the business, understanding what they're going to net from the transaction, and is that going to be sufficient to replicate the earnings and other benefits you currently have in an ownership position in the company. I talked a couple times about risk on the last slide, and I'll touch on this one quickly, but we could spend probably a whole webinar discussing risk inside privately held companies. I broke them out into two different areas, one external factors and internal factors. The external ones are things that are generally outside the control of the business owner, the general economic environment, the capital availability, both debt and equity, what may be happening in a particular geography, that type of thing. The other would be industry factors. Are you in an industry that is growing? Is it shrinking? Is it subject to disruption? Those are all things that are going to impact financeability and impact value of the company. The areas that you do have control over as a business owner or an advisor to a business owner are the internal factors. And these are in no particular order, but all relevant, and these are all things that a lender or private equity or some other type of buyer are going to look at in fairly deep detail. The first is, do you have a strategic plan, and are you operating the business according to that plan? Many people draft a plan, put it on a shelf. It becomes an academic exercise, and they're not operating the business through that filter. The senior management team, very critical as the majority shareholder departs. How deep is that team? Is there a succession plan in place like we spoke about on the last slide? Sales and marketing. Are you incenting your sales team to stay with you through a transition? As much as the key buyers need to be identified and taken care of, the key salespeople need to be identified and taken care of as well. Often overlooked but highly important, the human resources aspect of a business. That really is one of the most critical intangible value components of the business. Is your employee documentation in order? A lot of companies, I hear this from clients now, is what's the labor pool availability? I've got the work, but can I execute on that work? And are you investing in your people? Are you developing them, developing the future leaders of the company? Operations, you might have a great sales team, but if you can't execute, both you have a poor process internally, or that process is not documented and easily understood by everybody, that's going to gum up the works and impact value. Finance goes beyond just the financial statements of the business. It's very important to a lender to have good quality financial statements and to a potential buyer externally. But are you running your business with financial dashboards and operating reports that you understand where you are day in and day out? And then certainly from a legal standpoint, making sure that intellectual property is protected, that you have non-compete agreements, non-solicitation agreements, that type of thing with employees. So a lot of this identified in the risk slide before, but if you focus on driving value in your business, you're going to lower the risk profile of the business, which is going to be more appealing to finance a transaction. I did not put these in any particular order, although the biggies for financing a transaction are you've got to have positive revenue and EBITDA trends. If you've got profit, loss, profit, that's going to be a difficult transaction to finance. I mentioned earlier the quality of financial statements. That's an easy fix. It's not highly expensive to move up the quality of the financials that you get from your accounting firm, and you're going to see a benefit from not only a value standpoint, but the financing capability of the business, which is going to give a buyer the ability to buy or pay you a higher value because they can finance more of it. We touched on owner relevance to the business, strong management team, customer diversification. All these things and more lower the risk profile of the company if they're proactively worked on years in advance of an anticipated transaction. So being financially or being transaction ready really focuses around reducing company-specific risk, working on the things that we just talked about in the last couple of slides. The increased risk in the business lowers the value and also the probability of financing the transaction. So if we decrease risk in the business, we're going to increase the probability. In a lot of cases, you as the seller of a business, you're going to be asked to hold a seller note of you getting repaid, and also the cash flows of the business pre and post transaction are going to be much more certain, which again from a banker standpoint is critical.
Check.
I'm sorry. Can you all hear me now?
Yep, go ahead.
All right. I think I blacked out for the last one. Not sure. I think it was on financing readiness when maybe no one could hear me. Is that correct?
Yes, it was just a second's worth.
Okay. So if I touched on transaction financing readiness, my apologies. But just real quick here, lower risk translates to higher value and higher probability of getting your transaction financed. So let's move on to a couple of different options for financing an internal buyout. The first would be a conventional bank loan. I'll talk about the salient points as it relates to this and other options, and then we can contrast these a little bit towards the end in the Q&A section. But generally speaking, the maximum repayment term on a conventional basis is 5 to 7 years, and in some cases shorter. Most of these business acquisition or shareholder buyout transactions are largely intangible value based. So that's the reason why they have to be amortized in short order. They're not asset good per se. In the case of a conventional loan, you can finance either a partial ownership transfer, so you may have somebody that wants to buy in a minority interest, or a 100% change of control transaction. So a little bit more flexibility with a straight bank loan from that perspective. There needs to be a distribution policy put in place so that the buyer of the business on a partial basis has enough cash flow there, net of taxes, to be able to repay a bank loan that they're going to take out. Collateral is important. Obviously, buying in a minority position where the bank is not going to necessarily be able to tie into company assets to secure that loan. So there's going to need to be personal assets of the purchasing shareholder pledged to get the bank comfortable from a collateral standpoint. And more often than not, the bank's going to be asking for the selling shareholder to provide a guarantee, if not the business, in addition to provide the guarantee. So a little more stringent rules around doing a business act or a shareholder buyout using conventional financing. Let me talk about 7A financing, which is one of the financing products that we at Florida Capital Advisors through Florida Capital Bank specialize in, and that's 7A financing. These loans are perfect for a business acquisition or shareholder buyout for the reasons that we'll outline here in a second. Within the last few years, the SBA also increased the availability of the loan amount up to $5 million. It used to be $2 million. So there are a lot more transactions that can be done with 7A lending now that could not be done even a few years ago. So the biggest difference between SBA and conventional financing would be that the term is a maximum 10-year term or longer if real estate is a piece of the transaction. So what that does is, one, it gives the company more runway to pay the loan back. Two, it's better from a cash flow perspective because now there's money available to reinvest in the business, reinvest in working capital, etc. The biggest advantage here is that, again, intangible value is the biggest component of business value. And through the SBA loan, because the SBA provides the lender a 75% guarantee of the loan amount, the lender is comfortable with going a longer term and less collateral dependent. So with that said, though, cash flow is critical to underwriting. So what I said before about having choppy earnings, that's not going to be the best time to try to do internal transfers with SBA loans if there's not a steady earning stream there, because again, not collateral good, cash flow is absolutely critical to getting that loan done. There may be the need for personal assets to be pledged of the buyer if there's not sufficient collateral. Again, there won't be by definition because there's largely intangible value in these types of transactions, but there could be personal assets that are required. But the bigger difference is the selling shareholder will not be asked to guarantee the loan. However, they will be in a subordinated position on a seller note. They'll be allowed to get payments, but they'll be subordinate in terms of priority. So let me touch on, and these are on our website as well at flcbadvisors.com, but the key requirements of these loans for a business acquisition or buyout transaction is it has to be a 100% change in control. Unlike the conventional loan where it could finance a minority buyout, these have to be 100% change in control. However, it could be minority shareholder buying out majority or vice versa. There needs to be a 10% equity contribution from the buyer. I'll touch on this in a little bit more detail and provide some clarity there. The seller cannot be active in the business after 1 year. So important to go back to what I talked about a few slides back, and that is, please, be prepared that your income is going to cease after 1 year. You can stay on in a transition mode as an employer or a consultant, but past 1 year, the SBA does not allow that. Again, the positive financial performance is critical. The business transaction has to be supported by a credentialed business valuation firm, a certified valuation. So you can't draw up an arbitrary value for the business because it won't get financed if it does not appraise or get valued in that particular at that particular number. And then last, I'll touch on and move on, and that is that a 5-year, some cases more, non-compete agreements required. So you can't sell your company and wait a year or two and then go open up a similar company, in the same market. So let's talk a little bit deeper about buyer equity. As I mentioned on the last slide, at a minimum, the SBA requires a 10% equity projection of total project cost, and I'll run through an example of project cost here in a second. The equity cannot be gifted. So back to the planning process, let's start early. Let's identify who's going to buy the business internally. Let's maybe execute a minority shareholder buy-in, let them get a ownership position in the company prior to the full transaction taking place, or begin to bonus them well in advance, at least a year or so in advance of a transaction, because if it's gifted or has an appearance of being a last-minute distribution out, then the purchase price of the business is going to be reduced, or the SBA is going to expect that gets reduced. Key managers also, if that's who the buyer is, they may use accrued but not yet bonuses for the equity requirement in the transaction. So let's talk about on a business acquisition what defines project cost. So as I mentioned, at least a 10% equity injection is required of the total project cost, and we'll go through the project cost here in a second. Equity can come from the buyer and the seller. So what I mean by that 10% equity requirement can be split. However, if the seller is contributing to equity, then that seller note has to be on full standby for the entire life of the loan. So that means no payments of interest or principal for 10 years. Now, if you're providing no equity, but you're providing a seller note as part of the capital structure, and that 10% equity requirement is met, then those seller notes can receive a payment. So again, if you all have questions, we can field some of these at the end, or I believe my contact information is at the end of the deck. You can email me offline and we can talk deeper about this. So total project costs are just not the enterprise value of the company. So what I did here is an example that shows we got a $3 million company in enterprise value. That's the amount of the purchase contract. There's attorney's fees, some due diligence by the buyer, an SBA guarantee fee, and that generally runs 3+% of the loan amount. So it's not insignificant in terms of the cost, but it's a financeable cost and can be included in the total project cost, as can other miscellaneous items like business valuations, due diligence, that type of thing. What I did not put in here, but it is a legitimate project cost, is if there's some permanent working capital needed in the business as well. That's a financeable item, and that can be included in the total project cost. So the total project cost in this example is $3.1 million. The equity requirement here is $311,000. A little bit more around a buyout transaction. So the slide before talked through a whole company acquisition. This would be one, two, three shareholder type of company, maybe more, buying out and leading to a change of control transaction. The key bullets here to keep in mind is that the remaining owners are going to be asked to certify that they've been actively involved in the business for the last 24 months and held the same ownership position for that period of time. They can increase the ownership position over that 24-month period, but cannot decrease the ownership position during that 24-month period. In terms of the leverage position of the company, the balance sheet for the most recent fiscal year has to show a debt-to-worth ratio not to exceed 9-to-1. Pretty highly leveraged balance sheet, but if the transaction results in a negative net worth, or the company has a negative net worth, then there is going to be a requirement of at least 10% of that stock that's being purchased as a requirement of the loan. It's not going to be able to move forward without an equity contribution. And unlike the whole company acquisition, that cash contribution cannot be 5% buyer and 5% seller.
Check.
Let me conclude with some key takeaways. We went through this call quickly, and I encourage you all to reach out to me either by phone or email if you want to go a little deeper in the process. But the first would be start a planning process well in advance. Think back to the trigger event slide that you have the power to do this well in advance. Don't be reactive to this. Be proactive, because time will allow for a better executed transaction. Make sure you understand the value of your business. That gets to the personal planning side. If you're estimating a value of your business based on what you're hearing in the market or from an industry conference of what a competitor sold for, then you're potentially making some flawed assumptions about what you're going to get from your business. So either spend the money to get a valuation, or work with an advisor that can give you a range of values, so you really are working with a number that makes sense. Identify those internal buyers and put them in a position financially as well as developmentally to be able to execute a transaction well in advance of the day you plan to do that. The de-risking initiatives that I alluded to and the value drivers I alluded to earlier, that takes time to do. If you don't have a clear successor internally, you're going to have to get one externally, groom them, which is often a multiple year type of experience, and they may or may not work out. So at the end of the day, I'll leave you with, plan for all contingencies, because if you don't, inevitably it's going to make the transaction at the time that you want to do it not executable. So Tammy, I'll stop there and open it up for questions.
Yep, absolutely. So we definitely have several questions here, and some we might go over the information again, but I think that's okay, because I think it's important to underscore some of these questions that folks have. So a question, I think, from Olive that addresses or goes along the same line as what you were just talking about is, when is the most opportune time to start your exit strategy? And then, what are those initial steps? Where do you start?
Yeah, well, it's a great question, and one that is tough to compress into a 2 or 3 sentence answer. But I think the more time that you can dedicate to an exit, the better, because one, it's going to give you time to address risk points in your business and drive the value of the business, right? So at the end of the day, when I said understand the value of your business, don't wait till the last minute, 6 months or a year to do that, because that value either may not be there for you in terms of you being able to walk away from the business, or it may not be enough, and so it could take, in some cases, multiple years in order to get that value to the point that it meets your needs, and also it could take years to work on some of these other initiatives to put the company in a position where it can be financed or purchased by somebody internally.
So from a valuation standpoint, is this an exercise that you should go down that path on a regular basis, so that, you never know when somebody might come in and say, I want to buy it. So having that valuation or a sense of what that valuation is readily available, is that something that folks should do?
Yeah, so I think it's a healthy exercise. Again, it doesn't necessarily need to be a full-blown certified valuation to get a benchmark for what your company is. You can work with an advisory firm. We do this with clients and prospective clients, where we will give them a range of value, and that range of value is based off a risk-adjusted discounted cash flow of earnings. So we do all the earnings restatements, the EBITDA restatements. We go into a very comprehensive assessment of the business to understand where the risk points are and come up with a cost of capital or a discount rate for those cash flows, and can position the company in a value range. And then in terms of how frequently you want to do that after you do it initially, at least every 2 years, but probably every 1 year, because let's face it, we run our business for a multitude of reasons, but one of the biggest reasons is to drive the value of that business and ultimately extract that value. So to understand how you're running the business and how that translates to value year in and year out, I think is important.
And then from a financial standpoint, how important is it to have a CPA prepared review or audits of the financial statements?
Well, the CPAs are going to love this one if there are any on the line. I think it's probably the biggest bang for your buck. So I don't know what an audit or a review would cost for any particular company. It's going to vary depending on the type of company and the scope of work. But in terms of valuation, you'll get a 10x return on whatever you spend, or perhaps more, in getting those good quality financial statements. In terms of getting a transaction financed, you're going to increase the probability that that transaction gets financed on favorable terms, because the lender, just like a buyer, can put a great deal of faith in the financials, right? It has some independent review to it, or a full audit to it. Now, a buyer is going to do their own quality of earnings as part of their due diligence, but from a lender's perspective, having better quality financials makes us feel a lot better about lending into the transaction.
Great. So Ryan's question, as a 28-year-old millennial, do you think it's better to buy an existing business or start one from scratch? And in that same light, are there any loans available specifically geared to the military veterans?
Yes. So great question. And there are, and I would encourage any of y'all, but especially millennial, to Google search funds. There is these are connected with currently Stanford, Harvard has one, I believe Booth School of Business has one, and maybe some other universities as well. But the whole idea behind a search fund is to back a generally late 20s, early 30s, well-educated entrepreneurial type that has the the capability and an intellectual horsepower to run a business, but maybe not the capital to do it. SBA loans can help fund that transaction as well. So I would say if I were going to give them the choice about starting something from scratch versus buying an operating company, to the extent that you do your due diligence on the operating company that's already has a workforce in place, has some performance, operational performance, other types of things that we talked about that represent the intangible value of a business, I think it's, generally speaking, a lower risk type of transaction to try to buy something as opposed to start it organically from scratch.
Another question is, say they want to stage the exit of their business maybe over the next 3 to 5 years, what do they need to do to accomplish the financing of that transaction?
Right. So if a seller or an owner is going to execute it in stages like that, I guess one of two things can happen. One, the owner of the business can decide on a percentage of the business to sell to 1 or 2 or 3 key people. They can finance that transaction, hold the paper on it, and get repaid from distributions that the buyers receive. From a buyer's perspective, they've got to make sure those distributions not only cover their tax liability, but the ability to pay back that owner loan. Same thing would apply if those key people went to a bank to borrow money to finance the transaction. They would provide their financial information to the bank. The bank would lean in on what their income and distributions are going to look like post purchasing the stock. And as I mentioned earlier in the slide deck, is that there's generally going to be personal assets pledged to that, and in some cases, if that doesn't provide enough comfort for the bank on a conventional basis, the business owner may be asked to guarantee that as well.
Neal's question, what is the mix of recourse to non-recourse financing options? And he's got a follow-up question as well.
Okay. The SBA loans are all recourse. So anybody that is going to own a 20% or greater interest in the company has to be a guarantor. That's an SBA mandate. Same thing on conventional loans. I don't know many lenders that are going to do business acquisition financing on a non-recourse basis unless they're extraordinarily well secured with collateral. But even then, I just don't see that in the market. Not saying it doesn't exist, but I just haven't seen it.
And then Neal's follow-up question is, what are the trends in equity requirements for buyers, and what about equity rollovers for sellers?
Well, so as it relates to SBA, we touched on the minimum equity requirement there is 10%. Just because that's the minimum doesn't mean that's what the lender necessarily is going to require. I think that there could be situations where the lender wants to see more equity go in, 20% equity or 15% equity. Or if it is a 10% equity type of transaction, then they're going to be looking at the buyer's personal resources to make sure that they have some additional liquidity in the event that the company needed some equity injection for working capital purposes or the business backed up. In terms of private equity, which is not necessarily the topic of this, but I'll touch on it real quick. Private equity, it will come in both a minority or a majority position, depending on the type of company and the industry that it's in. It will back management teams and family members to buy out owners. So as you get into the larger transactions, the above the $1.5 to $2 million in EBITDA that kind of take it out of the SBA lending realm, then that's where private equity would step in and provide the equity capital and go find financing to help accomplish that transaction. Any other questions, Tammy?
Yes, we do have a question from Marcus is, while you're working on generating steady and consistent cash flow, what kinds of creative compensation would you recommend for acquiring key talent, especially if you can't compensate their desired rate?
I think what was the last part of the question, especially if they can't
compensate them at their desired rate?
Right. Okay. Meaning their W-2 wages or bonuses can't be.
Yeah.
Yeah. Okay.
Right.
So I'd maybe caution against giving equity, but there are things that giving them the opportunity to buy equity at maybe some type of reduced value would be one. There are phantom stock programs or other types of programs that are available out there that the key in person, without being comped on a cash basis, can participate in value growth in the business. We don't advise on that. There are companies out there that have executive compensation plans that are both cash and non-cash in nature. So I would seek out a firm that can provide guidance there. Cash, obviously, if you're setting things up for somebody inside the company to buy it, then getting equity into their hands and/or cash into their hands to be able to buy you out, however, is critical. But in the young stage of a company, sometimes that's difficult to do.
Question from Olive. Considering that all the variables are met for a business acquisition, what is the approximate time frame from start to final acquisition?
It's like a snowflake. Everyone's a little bit different. So in terms of, I've seen there's two components to the answer. One is how long does it take the buyer to go through the due diligence and the back and forth of that negotiation to finalize a purchase agreement. And sometimes that can be done in a month or two, and sometimes that can stretch out to 6 months or more. But the longer that stretches out, I think everybody's heard the expression that time has a tendency to kill all deals, and that is the case. In terms of doing the financing, what we do as a financing source is we get the information we need. We provide a due diligence checklist to the buyer of the business. They get us all that financial information. We issue a term sheet. We can do that, inside a week to 10 days, a non-binding term sheet. And then from the time that we have everything we need from the buyer, we can get a transaction closed, inside 60 days. Again, some of that takes a little bit longer, sometimes a little bit less. It just depends on how complete the information is and how the process is moving between the buyer and seller of the company.
Any additional questions, please type them in. Any final comments, words of advice, Chuck, for the group here today?
No, I'm out of gas on the advice. I would just look, if anybody wants a copy of the slide deck, Tammy, I don't know if you're going to provide that, I know. Yep. And then we'll also have this posted on our website at flcbadvisors.com. And I do, again, encourage anybody that wants to go a little deeper with this conversation, because we did rush through it a little bit, feel free to reach out and call me. Or email me. And Tammy, if you can maybe just throw up my contact information there one more time so people can get that. I appreciate the opportunity to present to everyone today, and have a great day.
Thank you very much, Chuck. Thank you, everyone, for joining us. Have a wonderful rest of the week.